Flip patterns are one of the most underrated setups in smart money concepts, yet they deliver some of the highest win rates of any SMC model. And when you combine them with higher time frame context, they become even more powerful than standard change of character setups. If you understand flips properly, you can spot major reversals and trend shifts before the market makes its move. That's why today, I'm going to show you a complete trading model built around flip zones, how they form, how to identify them on any chart, and how to turn them into clean, A-plus trading opportunities step by step. This strategy is simple, powerful, and one of the biggest edges you can add to your SMC toolbox. We always appreciate your support, so make sure to give this video a thumbs up. And if you're new here, don't forget to subscribe. See you right after intro. Welcome back, traders. So, let's get started. This powerful trading setup combines higher time frame flip patterns with optimized entry models, such as breaker blocks or mitigation blocks, creating a highly effective trading model with the potential to deliver A-plus trades on any chart and pair. In a bullish scenario, this setup forms when price flips the latest demand area right after tapping into a higher time frame area of interest. Price then returns to the newly created flip zone, which now acts as a supply area, and from there, it usually reverses sharply, pushing completely against the current trend and confirming a potential shift in market direction. Similarly, in a bearish scenario, this setup develops when the price flips the most recent supply zone immediately after being rejected from a higher time frame area of interest. Price then pulls back into the flip zone, signaling a potential transition from bullish momentum to bearish pressure. Of course, it's not as simple as it sounds. Several important criteria must be met before this setup becomes valid. So let's make it crystal clear with a price chart example. So, in a bullish market profile, imagine price originates from a higher time frame demand. That means demand zones are in full control. The first thing we need to do is identify the market direction by marking out the breakouts and the demand areas tied to each impulse leg. Because every time price breaks a high to the upside, it forms an unmitigated demand zone at the origin of that impulse move. You can mark out BOS and all other SMC elements manually, but if you want to automate the entire process, just like we're doing in this video, you can use the Price Action Toolkit indicator. You can even try it for free because it comes with a 30-day money-back guarantee, in case you decide it's not for you. So if you're interested in using this indicator, check out the link I dropped in the description box. Now, after applying the Price Action Toolkit and activating the BOS boxes in the Market Structure section, you can clearly see that the price is in an uptrend. It has already formed several break-up structures to the upside, and these are the demand zones tied to each of those impulses. What we want to see next is price tapping into a higher time frame point of interest. In this case, an unmitigated supply zone, or an unfilled fair value gap, and showing rejection. Once that happens, price shifts direction and pulls back until it reaches the most recent demand area on the current time frame. It then tests that zone, shows a minor reaction to the upside, and immediately breaks through it with a strong bearish displacement leg. This sequence of events confirms that supply is taking back control of the market, signaling an upcoming shift in market direction. Now we have a flip zone sitting in the premium area, which gives us a perfect selling opportunity if the price pulls back into it. This might look a bit complex at first, but don't rush it. Relax. We're going to break everything down into actionable, easy-to-follow steps, with all the criteria and rules you need before the setup becomes valid. But before diving into those details, let's quickly recap what flip zones are and how to properly identify them. A flip is all about a minor reaction of price to a key demand or supply zone, followed by an immediate breakout. It's a strong reversal pattern that signals an upcoming shift in market sentiment and direction. Flip entries are one of the best ways to jump into a setup quickly while the market plummets or soars. In a bearish scenario, the core psychology behind a flip is simple. Price is in an uptrend, demand zones are in control, and we naturally expect price to keep pushing higher. But suddenly the entire narrative changes. The latest demand fails to generate enough bullish momentum to break new highs. It weakens, loses its influence, and eventually gets broken. This zone breakout tells us supply is back in control, and from this point on, we should be looking for selling opportunities. So the last up-close candle, or the cluster of up-close candles, at the origin of the bearish flip move becomes the flip zone. In simple terms, those bullish candles inside the reaction phase represent a key area where we should look for short opportunities if the price pulls back. Similarly, a bullish flip zone forms when price shows a minor reaction to the latest supply and then immediately breaks above it. So the last down close candle, or series of down close candles, at the origin of the bullish flip leg creates the flip zone. Now you might ask, what's the difference between a change of character and a flip? Flips are similar to CHOCHs because both are reversal patterns. But here's the key distinction. Every flip is a CHOCH, but not every CHOCH is a flip. Price usually reverses much faster when a flip forms, which means flip patterns offer a stronger edge than standard change of characters. They're also more mechanical, rule-based, and easier to trade because they give you a clear entry point while signaling a potential shift in market direction. But remember, not every flip is valid or tradable. For a flip to be considered valid, the price must first mitigate and reject a higher time frame key zone. This rejection shifts market sentiment and sets the stage for a true directional flip. If price does not mitigate a supply or demand zone and instead creates a flip pattern in the middle of nowhere, it's probably just an inducement, a liquidity grab, or a normal retracement, not a real shift in market direction. And patterns like that must not be treated as valid flips. Additionally, flip patterns become even more effective when the price leaves a noticeable inefficiency behind during the flip. In that case, price is far more likely to return and mitigate the flip zone. To apply this strategy properly, you'll need to work with 3 time frames. A higher time frame to identify unmitigated areas of interest, such as supply or demand zones. A main time frame to analyze overall market conditions and to spot flip patterns and flip zones. And an entry time frame to zoom in and look for reversals and confirmation signals. This is where you'll actually place your entry. These are my recommended combinations that you can use. Of course, you can use other time frames as well, but make sure to backtest them first before trading them live. Now let's go step by step and see exactly how this plays out on the chart. But before we continue, in a bullish scenario, the very first step is analyzing market structure on the higher time frame and identifying the nearest unmitigated demand area that price is likely to reach. Once price taps into that higher time frame area of interest and shows rejection, the setup begins. Next, zoom into the main time frame and wait for the price to retrace upward to test the most recent supply area on the main time frame. After a small reaction to the downside, the price should immediately break above it. In other words, flip the latest supply. From there, trace back to the origin of the bullish expansion move, the reaction phase that initiated the break. That origin point becomes the flip zone. This flip tells us the temporary bearish retracement is ending and bullish momentum is returning. At this stage, we expect price to realign with the higher time frame trend. The next step is to highlight the flip zone on the main time frame, then wait for the price to return to that zone. Once price taps back into the flip zone, zoom into a lower time frame and closely monitor for reversal signals such as VSR patterns or a clear market structure shift. At this stage, we have 2 different entry approaches for opening a long position. Each has its own strengths, the mitigation block and the breaker block. In the first entry method, after price taps into the main time frame flip zone, if a mitigation block forms on the lower time frame, it provides a strong opportunity to go long. For a bullish mitigation block to form, price must first create a swing low, then a swing high, followed by a higher low. After that, we need to see a market structure shift with a bullish displacement leg that closes above that swing high. In this case, your bullish mitigation block will be the up-close candle, or series of up-close candles, formed between that first low and first high. To execute the long trade, place your limit order at the highest point of that mitigation block and wait for the price to activate it. For a take profit, you can target the nearest liquidity pool on the current time frame or aim for higher time frame key levels if you want a larger move. Now, note that the breaker block is different from a mitigation block, because with a breaker block, we look for a lower low, not a higher low. So in the second entry method, we wait for a bullish breaker block to form inside the main time frame flip zone. For a valid breaker block, the price must first create a swing low, then a swing high, followed by a lower low. After that, we need an immediate expansion move in the opposite direction that produces a market structure shift. In this scenario, the up-close candle, or cluster of up-close candles, between the first swing low and the swing high will define your breaker block area. That's the zone you'll use to open a long position. And of course, the same concepts apply to bearish entry methods, only in reverse. Now that we've covered all the rules, details, and everything you need to apply this strategy correctly, let's walk through a real chart example to solidify what we've learned so far. Here we have the Euro-Dollar 4-hour chart on the screen. As you can see, price is in a strong downtrend and the bears are clearly in control. The most recent bearish BOS is located right here. At the origin of the move that created this BOS, we can see an unmitigated supply zone. So I'm going to highlight this up-close candle as my supply area. This gives us a fresh, clean supply zone. And this is exactly where we want to keep our eyes because it's an ideal area to look for short opportunities if price pulls back into it. The next step is simply to switch into our main time frame, which in this case is the 15-minute chart, to get a clearer view of the price action and wait for the price to tap into this 4-hour unmitigated supply. Now let's unfold the chart and see what happens next. On the 15-minute chart, you can see that after tapping into the higher time frame supply, price reversed and formed a clear VSR, a classic V-shaped recovery pattern. If you mark out the bullish BOS levels, you'll notice that the price created several successive demand zones on its way into the 4-hour supply area. Also, after tapping the higher time frame supply, price retraced downward and, after a small reaction, flipped the most recent demand by breaking and closing below it. At this point, price is expected to realign with the higher time frame direction, which is bearish. So now we have a valid flip zone on the 15-minute chart, represented by this up-close candle. With these confirmations in place, we can expect the price to return to the flip zone before continuing its move toward the sell-side liquidity. Next, we need to wait for the price to return to the flip zone, then zoom into our entry time frame, the 1-minute chart, so we can identify a precise entry for a short position. On the 1-minute time frame, you can see that the price pushed upward and after tapping the flip zone, reversed sharply and formed both a market structure shift and a VSR. At the same time, it created a breaker block, represented by these 3 down-close candles. Notice the sequence here? Price first formed a swing high, then a swing low, followed by a higher high, but immediately after, it reversed direction and closed below those down-close candles. This confirms the breaker block and gives us another strong confluence for a short entry. With these confirmations in place, we can expect the price to pull back to the breaker block before continuing downward towards sell-side liquidity. Next, I'm placing my entry at the lowest point of the breaker block, with my stop loss just a couple of pips above the higher high. For take profit, I'm targeting the sell-side liquidity below this swing low. Now let's see if the trade plays out successfully. As you can see, price pushed higher, triggered the sell limit order, then dropped lower and eventually hit the take profit. Now let's move on to the next real chart example. Here we have the Pound Yen 1-hour chart on the screen. As you can see, price was in a strong uptrend, until everything changed when price broke and closed below the lowest point of the most recent bullish BOS, forming a clear bearish change of character. From that moment on, the price continued pushing downward. So from here, our bias shifts, and we're now focused on looking for short opportunities. If you look closely, you'll notice an unmitigated 1-hour supply area sitting right above the current price, a perfect zone to look for selling opportunities if the price retraces back into it. The next step is simply to wait for the price to tap into this 1-hour unmitigated supply. Now let's play out the chart and see what happens next. As you can see, price pushed higher and tapped directly into the higher time frame supply zone. Now everything looks perfect, so I'm going to zoom into the 5-minute time frame for a clearer view of the price action. And here on the 5-minute chart, you can see that after tapping into the higher time frame supply area, price reversed and, after reacting to the most recent 5-minute demand area, immediately flipped it with inefficiency. I'm going to highlight these up-close candles as my bearish flip zone. This gives us a fresh, clean supply area. Next, we zoom into our entry time frame, the 1-minute chart, and wait for the price to return to the flip zone. Now on the 1-minute chart, you can see the price pushed upward, and after tapping the 5-minute flip zone, reversed and formed a clear market structure shift and a mitigation block, represented by these three up-close candles. Notice the sequence. We have a swing high, then a swing low, followed by a lower high, and immediately after, a reversal that closes below the swing low. With this behavior, we can anticipate that the price will return to the mitigation block zone before continuing its move toward the sell-side liquidity. Next, I'm setting my entry at the lowest point of the mitigation block, with my stop loss just a couple of pips above the upper swing high. For take profit, I'm targeting the sell-side liquidity below this swing low. Now let's play out the trade and see how it unfolds. As you can see, the order was triggered. After a brief drawdown, the price reversed, pushed lower, and eventually hit the take profit, exactly as expected.